it's, greed and fear. And the fear could be fear of loss, could be fear of missing out, but it's fear. And, greed, speaks for itself. So that's basically, you have to build in. And my whole focus on predetermined exit strategies is to try to immunize as best I can, immunize myself from my emotional self, right? Because I know myself. I know what my strengths and weaknesses are, at least I think I do. And I'm trying to save me from myself by having predetermined exits so that I don't get whipped out like that.
Welcome to the Rose Show podcast. Thank you so much for joining us. I'm here with the urban cowboy, as he's known on Twitter, Michael Cow. He's been in the investment business for over 30 years. He has experience in analyzing and investing in many markets and asset classes, from commodities to credit to convertible capital structure and event arbitrage to distressed debt equity investing. So, and in his LinkedIn profile, his number one top skill is known as making money. We certainly love that, as this podcast is about making money.
About that.
Yeah,
That's
keeping
really
money and enjoying your money. And Michael Cow knows how to do that. How you doing today, Michael?
All right. It's so fun to be back with you, Rosanna.
It's so fun to have you.
We have so many themes and interests in common. So
I'm
it's
so
uncanny.
honored.
It's uncanny almost, right?
I love it. I'm so honored because you're super brilliant and super cool. Loved your pictures from that recent Metallica concert. We both love Metallica. Really cool stuff, and Greek and Roman mythology, and so much more, and markets. So I want to begin with markets. Before we get the overview and go into your positioning and your macro cap ARB, I want to know your thoughts on the market, not just today, but lately since we last met.
Yeah, so that's been a while. I think, my big picture worldview is this. I in fact, yesterday I tweeted out a very brief mental model tweet. I said, this is my sort of dry tinder mental model for inflation. I think that oil was kind of the spark that started what I call this inflation conflagration at the beginning of 2021. But it's not necessarily sustaining the current inflation, or at least the stickier structural components. I think that the stickier structural components are well encapsulated in a thread I wrote a couple of months ago called the 4 horsemen of economic resilience, right? Those 4 horsemen are, there are structural demographic elements to what are keeping shelter and labor inflation sticky. There's the second horseman, which I think is probably the biggest horseman of all, which is this fiscal tailwind. There's leftover tailwind from the COVID era, but there's, more importantly, unspent tailwind from the 3 fiscally expensive projects of the the bipartisan infrastructure bill, the Inflation Reduction Act, and the CHIPS Act. I think as of November, I estimated that of the 2.2 trillion earmarked for the next 5 to 10 years, as of November, only something like 16 billion had been spent. So that's definitely a horseman that the rest of the world doesn't share. The third horseman is just relative floating rate insensitivity of the U.S. consumer and corporation. Just, with our very, very low percentage of floating rate mortgages and relatively low percentage of floating rate corporate loans, 25% here versus say 75% in the Eurozone. And then the fourth horseman of resilience would be just our relative energy independence, right? And so it's a good segue into what we're seeing today with this OPEC meeting, because a lot of people, especially with the Israel-Hamas war, people thought, okay, you know what, this is going to be 1973 all over again. And I argued then, and also recently on a podcast I did with Scott Smithson about the geopolitics of commodities, saying that I actually think that the geopolitical risk right now is actually to the downside, because I think over a year ago now, OPEC, mainly Saudi Arabia, started off with these cuts. And they were voluntary cuts, and I called it premature emasculation of demand, because they are say, I view OPEC as the central bank of oil. I view the Fed as the central bank of dollars. So there's this big clash of the titans between the two. The problem, though, is that they both have one tool. The Fed has the one tool of the Fed funds rate, and OPEC has the one tool of restricting supply. What's messed up for OPEC is that their tool happens to be demand restrictive, just like raising Fed funds is demand restrictive. But furthermore, their tool has the perverse effect of keeping the Fed more vigilant than it ought to be, right? So going back to that sort of big picture layout, I said that, look, even though oil started the inflation conflagration, it's not necessarily sustaining it. There are other structural factors sustaining it. That said, OPEC is doing themselves no favors at the margins by having prematurely sort of cut all the supply very early on, and also keeping the Fed incrementally more vigilant than perhaps it might otherwise be at this point in the credit cycle, right? And so I think that leads me to think that between OPEC's actions, between the structural elements, the structural dry tinder I talk about, if the Fed actually starts cutting like a lot of the risk markets seem to be pricing in right now by the first quarter of next year, I think that structural dry tinder just gets reignited. And we have a replay of like what happened in the 70s and the late 70s, where, after the aggressive rate hikes from sort of like 78, 79, 80, even though they were aggressive, the stagflationary environment that characterized that period persisted, right? And by the time the Fed actually eased in 1981, the zeitgeist of persistently sticky inflation was already embedded into the market. And so when the Fed prematurely eased, the long end blew out in yield, because the long end basically said, we don't believe you can contain this inflation genie. And so I think that Jay Powell understands that is a risk. He's even voiced it on many occasions that he doesn't want to take that chance. But the markets are definitely not shy. All markets, equity markets, the dollar recently, gold, all the markets are pricing in a pretty aggressive return to easing, and I'm just not seeing it. So I'm fading those.
Great points there. You touched upon a lot of different points.
It's a lot.
I love it. We can take it apart and simplify it for everyone.
Yeah.
I know OPEC Plus had some action today, and a lot of all over the news. And I know, you talk about OPEC. I love that point that you make, how OPEC Plus is like the central bank, and how they're very comparable like that. And when they cut prematurely, they can reignite that inflation. Very important points there. And then you touched upon you were talking about 1982, and I know you've tweeted about that, going back to the 70s and 82. And then you talk about how the bear steepening of the yield curve could lead to a bull steepening, right? Yeah. Like 1982, and then the long end will blow out. I tend to believe that we still haven't seen the high yet in the long end. And I think that they're going to go much higher. And the worst thing that can happen, because in macroeconomics, about expectations. And if the people lose faith in the Fed, and that's when bad things happen. And that's when we can see that long end going out. So do you think we could replay the 1970s again with much higher debt? Because as we know from the GDP report came out yesterday, that G in GDP seems to stand for government and all their massive spending.
That's what I said. Yeah, that's exactly what I said. Yes, I literally said that yesterday. So the G in GDP is now government, because it's definitely a concern. I think that there's some that argue that the GDP is a backward-looking indicator, but I responded by saying with that tweet that I put out about how the 2.2 trillion that's been earmarked really hasn't been spent yet. That's forward looking, and that's an issue. I mean, remember when Liz Truss, Miss Lettuce, tried to institute all of these tax breaks, and the gilt market completely rebelled. I think that could happen. That could happen here for sure. But I think more importantly, what your point about my tweet about bear steepeners leading to a bull steepening. Yeah, I mean that's exactly what happened in the late 70s, because when you look at the yield curves, what usually happens with these bear steepening episodes is that initially the Fed hikes aggressively, and it looks like the curve gets really inverted, but then it kind of de-inverts as the long end adjusts, and that it did that three years in a row from I believe like 79 to 81. But by the time 82 turned around and the Fed actually cut, right, the long end blew out even further. So I guess you could say that that's a combination of a bear and bull steepening, right? Because
exactly.
the long end is coming down while the long end is blowing out. So that if that happened again, if the Fed made that mistake of prematurely cutting and reigniting inflation, I think that would be disastrous for asset prices. But like right now, the markets unfortunately are almost like taunting the Fed, right, and basically saying that you're gonna wind up easing, and the Fed has to decide whether or not they're gonna kind of take the bait. I think it would be a mistake if they did.
Agreed.
Yeah.
I actually wrote about that. I said that we don't want a Fed pivot. We don't want cuts. But we'll have to see what happens. I think there's
not prematurely, and that's why, when we talk about like OPEC and why I've been saying for like over a year now, since last April, I've been saying, well, they started with their first voluntary cuts back in I think October of 22, maybe, and I said this is
too soon.
I call it premature emasculation, because that's exactly what it is. They are prematurely emasculating demand at the margins, while having the perverse effect of keeping the Fed more vigilant than it frankly ought to be at this stage of the cycle. Now, I just said that there are other structural elements that are sustaining the inflation. So it may be that OPEC can't do much about those anyways, but at the margins, right, having high oil prices doesn't help, right? So that's the issue.
Well said. I think we both agree higher for longer seems very likely. We have labor and shelter inflation, very sticky, and inflation is, my opinion, embedded, entrenched in many pockets, and very likely that we see a harder landing than most people think. I like to be optimistic, but with what reality is. So I want to get your thoughts on oil before we get focusing more on the macro arb. You're short-term bearish, but long-term bullish. Is that correct? I know you don't believe in that peak oil whole theory like I do. I don't believe in it. I think oil demand will increase as time goes by. So give us your thoughts on your bearish and bullish cases.
Look, the bullish case is very, very well known at this point, which is that the dearth of long cycle investment is eventually going to come home to roost. And in fact, back in 21, I coined this term. I call it the supply demand singularity, right? Which I define as, at some point in time between the lack of capital spend in the long cycle projects, and the impermanence of shale, right? Because shale is a wasting asset ultimately. And of course, all of the capital displacement by all these unfounded ESG projects that seem to now be coming home to roost, and people are realizing that they're not really economic. You could have a supply demand singularity where even a recession impacted demand number might not meet the call for the global spare capacity. Now, the problem with this thesis is that, I felt like this, I originally thought this thesis could hit between 22 and 23, and then it just keeps getting pushed out and pushed out and pushed out, right? And the part of the issue that I see, and what made me turn bearish starting in April of 22, when oil was around 110, was that oil, because of the whole Russia-Ukraine war, had spiked to like 140. And I said, this is demand destructive. But more importantly, the one of the big problems was that initially the reason why oil spiked to 140 in the first place was that there was this expectation that all of these sanctions on Russia would potentially see the loss of 4 million barrels per day of Russian production. Guess what? We've not seen an iota of Russian production disrupted, because at the end of the day, all of these sanctions, I realized, were porous. Every single one of them. The only way to stop oil flows is an actual blockade, which would obviously be a casus belli, right? So all of these sanctions were toothless, maybe very probably by design, right? Because the world can't live without oil. But anyway, so the prices shot to the moon. They weren't justified. And then at the same time, the Fed started embarking on this aggressive hiking cycle. And then starting in October, OPEC started cutting with these voluntary cuts. So now spare capacity, right? The reason why the current situation is a far cry from 1973 is that in 1973, right after during the Yom Kippur War and the Arab embargo, that was a situation where, U.S. conventional production had already tailed off, and we really didn't know where our next molecule was coming from. We were completely dependent on the Middle East. And that's not even talking about the geopolitical side of the Middle East, right, where there was a lot more solidarity, right? You fast forward to today, where OPEC, Saudi Arabia in particular, has unilaterally cut to support this market. You've got Russia, you've got the UAE and Iran essentially cheating this whole time, right? And global spare capacity just within OPEC is close to 5 million barrels per day. If you broaden it over, and I'm taking these numbers from Lakshmi, who I think is the best oil macro analyst out there. Mm-hmm. She thinks that total global spare capacity is around 6.5 million barrels per day. Between that and U.S. shale production, which was non-existent in the 70s, where we are the largest producer in the world at over 13 million barrels per day. This is a far, far cry from 1973. And exactly. In fact, the reason why I think the geopolitical risk is to the downside is that, when you think that the ink isn't even dry on this OPEC meeting today, right, where they're essentially just rolling over the cuts. But you know what? I said that today's meeting headline, today's meeting has more holes in it than Swiss cheese. It's an insult to Swiss cheese because all of the cuts are voluntary, right? And to me, I tweeted out earlier today that this signifies a complete lack of solidarity. And it also means that Saudi Arabia is not beholden to support these cuts at all. And it also is a tell that the underlying demand is really, really weak, because if this was the base case, right, that OPEC that Saudi Arabia in particular would roll over its voluntary cuts. Well, with this base case having supposedly happened, with supposedly other countries like the UAE agreeing to more additional voluntary cuts, never minding the fact that UAE has been one of the biggest cheaters thus far. It's to me, it's like a complete bullshit meeting result today. So oil, as we speak, is down, like 2% or so. I'm surprised it's not down a lot more, to be honest with you. I think that they're out of bullets. I think they're out of bullets. And there's this great Paul Tudor Jones video that I've been circulating, and if you haven't seen it, it's called Trader. I think it was done back in like 1986. You have to watch it because it'll get taken down. But there's this epic scene in there where, again, this is around 1986 or 1987. There's Paul Tudor Jones in his office, and he's like shorting the crap out of oil futures on the eve of an OPEC meeting. And he basically said something like, you know what? If I get a chance to bet against 13 countries agreeing on trying to do something, and I have a chance to take a position against it, wild horses can't stop me from doing that. So like, this reminds me of that. And the ink isn't even dry on this OPEC agreement when Angola just said Angola rejects OPEC quota and won't stick to it. OPEC calls for Angola to produce 1.11 million barrels per day, but they're going to produce 1.18. I think that's just the beginning, right? Because it's Saudi Arabia. Look, MBS must feel like a chump, right? They voluntarily cut 3 million barrels per day. And, so to use Greek mythology, they're Atlas. They have borne the entire world of OPEC plus. It's unilateral. So the question is, when does Atlas shrug? If Atlas shrugs, this oil market's not going to 60. It's going to 40 or below. That's my concern. We've not, we saw what happened in the aftermath of COVID, when basically you had this pissing match between Russia and Saudi Arabia. And there was, when solidarity breaks down, it's bad, because then all hell breaks loose, right? And no one wants that. I don't want that, right? Even though I'm short-term bearishly positioned, I don't want to see that, because my longer-term thesis is expressed through this self-liquidating oil and gas private equity. So, I get a lot of my current passive income from oil flows. So and my short-term bearishness is expressed through XOP puts. I'm really just trying to protect a portion of my cash flows, because of my macro concerns on oil. So in many ways, Rosanna, I'm unlike a lot of people out there. I'm kind of talking against my book, but I'm very concerned about it, right? I'm not expressing what I want to see happen. I'm expressing what I think might happen and how I'm trying to protect myself against it.
Appreciate your honesty and what you see. And, that's how the market is. We have to be observers. And it's not about getting what you want. It's just about watching and reacting to it. And seems like you're doing a great job of that. I know you have a great discussion. You talk about hedging. And I'd like to go into, thank you for your oil thoughts. And it makes a lot of sense there. Thank you again. So I want to go more into your risk-averse value investing strategies. And I want to talk about your macro cap ARB and also your hedges, because you had a great tweet that you said when you put on a hedge that loses money, do you keep it and rationalize it as a hedge that's supposed to lose money, or was it just a bad trade? So why don't you start with that and tell us about that?
Yeah, thanks for bringing that up. I don't have a good answer for that, because that is actually a question I always struggle with, right? Because on the one hand, a hedge, if you think about it, if it's doing its job right, ought to lose money, because it's meant to protect your main trade, whatever that is, right? And so in my case, right, my XOP hedge is meant to protect the cash flows that I'm deriving from my oil private equity, right? That said, right, as an innate trader, right, you kind of want your cake and eat it too, right? And I hate giving back money even on my hedges, right? And sometimes I'm guilty of judging myself too harshly on losing money on hedges, when I remind myself that the whole reason for putting on the hedges in the first place is that if my main trade is correct, my hedge is supposed to lose money, right? So it's a constant struggle, and obviously, all things being equal, we want our cake and eat it too. Like I would love to be the perfect trader and be able to time my hedges such that I can make money on my hedges and make money on my main trade. But as we all know, that's much harder said than done, and that's why I have hedges in the first place, right? And the key to me is structuring the hedges in such a way that if you lose, it's an asymmetrically benign loss, right? And so I generally issue hedges that are symmetric, where I have open-ended downside. The one area where I do have sort of open-ended that I'm playing symmetrically is in the world of FX, where I'm just taking directional positions, right? And so there, because I'm taking leveraged directional positions, I have to watch it very, very closely, and I have to pay very close attention to stop losses. But in my sort of equity account, where I use a lot of options and option spreads, and then we can get into that macro cap arb, but I wrote a thread maybe 2 years ago about exit strategies, investing exit strategies. And this is really important, I think, really, really important. I think most people don't talk about this. This investing thread about exit strategies is where, so let me just take a step back for a second. So I cut my teeth as a junior trader at Goldman, right, in the early 90s. And I observed that the macro, making consistent money on directional macro trades is very, very difficult, right? Very difficult. And only the best of the very best, like the Druckenmillers and the Soroses of the world, have really consistently made money doing that. It's very, very difficult to do that on a consistent basis. So unless you're a Goldman Sachs where you're a dealing desk that can feast on the flows and the bid offer spreads of your clients, right? It's hard for a retail investor, for instance, to do that, right? So what's the next best thing? And so like when I started my post MBA career at Canyon, and then, well, first it was an internship at the Harvard Endowment, where it opened my eyes to all these relative value strategies like convert arb and risk arb, et cetera. That experience really made me think, when I landed my job at Canyon, which was primarily a credit shop back then, that I wanted to focus on an asset class where the exit strategy wasn't so dependent on a greater fool, right? So if you think about, and I always have to say this, when I say greater fool, I don't mean it in a pejorative sense. I mean it from the sense that when you buy something, whether it's a crude future or a stock, the way to make money, your exit strategy is for a greater fool to recognize more value than you did and take you out at a profitable exit, right? So that requires a high bar. It requires that somebody else perceives something that's perceives more value than what you did originally when you bought it, right? And greater fool strategies, if they're backed by fundamental analysis, you can have conviction in them. So like in a value stock, right? For instance, if it goes against you, because of whatever market technical forces bringing it down, if you've done your fundamental homework, you have the conviction to ride out those bumps. But when you have a greater fool trade that's not backed by fundamentals, and I'll always think about things like Bitcoin or gold, or things where you cannot value them with like a DCF, those greater fool trades they're much harder for you to stomach volatility in, because they're backed purely by technicals, and so you literally just have to be very, very disciplined about stop losses, right? So, but what are the other exit strategies? Well, what I thought convert arb and options arb offered was this notion of a replicating portfolio, right? So when if you think about basic options theory, right, you can dynamically replicate an option by trading the underlying stock and bonds in a dynamic fashion, right? And so without getting too hairy into the details, the gist of convertible arbitrage or options arb is that if you buy optionality at a cheap implied volatility, and actual volatility is higher than what you bought that implied volatility for, through dynamic trading of the underlying, you can scalp out enough sort of dynamic trading profits or gamma profits, right? That you're not dependent on the greater fool to take you out of your trade. And that's what I loved that. And that's what I built a career on, because I wanted to maximize my chances of winning and not necessarily be always beholden to the greater fool. So the idea behind dynamic replication strategies is that you're not dependent on the greater fool. There's one other category that's where you're not dependent on the greater fool, and that's what I call event-driven strategy. So the simplest event-driven strategy is a risk arb, for instance, where you've got an announced deal, company B is acquiring company A, and if you go long company A and short company B, as long as the deal closes, you make that spread, and that spread is made regardless of where the stock market is, regardless of interest rates. It's an event-driven trade. Your exit is predetermined. Now there's different risks. There's event risk, right? At its very heart, a credit strategy, being long a bond and clipping coupons, that's also an event-driven trade, because every single event, every single coupon payment, every principal payment is an event in and of itself. Because when that event happens, you get cash in your pocket, right? Your exit strategy for that event is predetermined. The event risk that we talk about in credit-oriented strategies is default risk or credit risk. The circumstances under which you don't get your coupon payment or your principal payment is an event of default, usually, right? So that brings me back to this whole macro cap arb thing, right? So right now, because I am, going back to the start of our conversation and my macro worldview and why I don't think the Fed is going to pivot as early as risk assets are implying, I'm bearish equities, and I'm bearish oil. But I'm hedging them asymmetrically through option strategy. So if I'm wrong, and I certainly have been recently, right, that I'm not going to get taken to the cleaners on those options, right, because my loss is limited. But on the other side of my book, I run my PA just very similarly to the way I ran my hedge fund, where I'm an alpha chaser. I'm not a beta chaser. So I'm not a passive indexer. I have zero passive risk in my portfolio. I have a concentrated book of a couple of idiosyncratic names, a bunch of which I think are kind of event-driven names. And then I also have this big positive carry component because, again, right, the positive carry component is that credit piece where the cash is coming into my pocket every month without me having to rely on the greater fool, right? My risk is that I'm taking credit risk. Well, and I've diversified, right? The way I'm getting my carry is through very diversified means. I've built a substantial treasury bill portfolio. So my credit risk is the US government, not worried about that. I also have a concentrated holding in a CLO equity closed-ended fund that's paying me something like 20% on a current basis. We can talk about that if you want. I also have allocated, since I retired from active hedge fund management in 2019, I've become a investor in other hedge funds. So I'm invested in, I have my oil and gas private equity, which I view as a short duration play on oil because I'm deriving cash flows that are derived from oil, which is why I'm trying to protect with my XOP hedges. And then I'm also invested in a bunch of other hedge funds and private equity style funds that are, some are based on RMBS, residential mortgage-backed securities. Some are based on real estate. Some are based on just opportunistic blending. You talk about like private credit type strategies. Well, I'm invested in some of those too. So my source of positive carry is very, very diverse. And some are directly within my control. Like for instance, I can trade in and out of my CLO equity closed-end fund. And then some are, less liquid, longer term holdings, like some of these private funds that I have.
Wow. Nice book you have there. Now you're very busy with your family office. So I like to unpack these in different sections. Let's start with your positive carry barbell between the bills, the T-bills, I'm assuming they're short-term bills, and the CLO equity. Tell us about and we talk about exit, but let's talk about your entry, what you look for, how you identify, and what you're doing right now with this CLO. If you're looking to add more,
I'll tell you why I like CLO equity, and it's probably beyond the scope of this podcast to give a full lecture on it. But CLO stands for collateralized loan obligation. So the leveraged loan space comprises something like 25% of U.S. corporate debt. So total U.S. corporate debt is about 16 trillion, and of that about approximately 3 trillion of it is leveraged loans, and half of the leveraged loans are typically bought by CLO structures. So CLOs should sometimes for people who don't understand them, people think that they're very scary structures. They equate them to CDOs. Remember, during the Great Financial Crisis, there's CDOs and CDOs, square collateralized debt obligations. These things blew up, right? A lot of the structures that blow up tend to have mark-to-market triggers. right? And if you think about it, Silicon Valley Bank blew up because ultimately it was forced to take a mark to market because its liabilities are daily deposits that fled out the door because of the concentrated deposit base that it was forced to take a mark to market on its mismatched duration on the left side of its balance sheet, right? So financial crises and financial blowups always happen because of asset liability mismatches, where a financial intermediary that's in the business of borrowing short and lending long winds up realizing that, holy shit, their liabilities are going out the door. There's the proverbial run on the bank. And these runs on the bank don't have to happen with banks. I've experienced them personally in my role as a hedge fund manager at the fund of funds level. Like back in 2005, I had a large fund of fund investor that committed the cardinal sin of promising monthly liquidity to their investors, but they were invested in quarterly and annual liquidity managers like mine. So when they had a rash of redemptions, they couldn't meet them, and they had to essentially declare force majeure and put the entire fund of funds into liquidation. So these asset liability mismatches are almost always created by short liabilities, long assets. CLOs are the opposite. The CLO structure has long liabilities. Okay, if you think about what a CLO structure is, they'll raise like 10 to 12 year debt and use them to fund leverage loans, which are typically anywhere from like 3 to 7 years in maturity. So the asset side of the balance sheet of a CLO is shorter than the liability side. The other thing that's interesting is that, look, CLOs initially, there were these things called mark-to-market CLOs that did have fragilities because of the way they were structured. The CLOs that we know today are called cash flow CLOs, where there's no mark-to-market trigger, and they are subject to certain tests called overcollateralization tests, if you think about any of these collateralization vehicles, what they do is if the left side of the balance sheet is a bunch of leveraged loans, they tranche it up and basically resell that risk in tranches, like from AAA, AA, all the way down to sort of, triple B. The CLO equity tranche is beneath all of that. So think of it as the lowest part of the capital stack, but for a product, for an underlying product, the leveraged loan, which represents the most senior secure part of the capital stack. Okay, they tend to be now these loans are because they're leveraged loans. They tend to be for sub-investment grade companies typically, right? But a lot of times these companies, like for instance, like one of the largest leveraged loan borrowers is this company called Asurion. I mean, if you have like cell phone insurance or whatever, you realize that, I mean, this is not a fly-by-night company. These are not fly-by-night companies, right? And so CLO. So I kind of briefly described the structure of a CLO and what gives it kind of stability. The reason why I like this right now, despite being in the at a late stage of the credit cycle, is that you go back to this fiscal tailwind that I keep talking about, right? Which is what has caused equities and all these pivot plays to fly up. And I was thinking, well, gee, I don't want to keep losing. I don't believe in these equity rallies, but the market is what it is, and I want to keep funding all my puts, but I don't want to just bleed to death. So how do I offset this theta bleed of all my option strategies? So I have treasuries, but treasuries are yielding 5% or whatever. And I thought that CLO equity is very interesting because number one, got into this. I've tracked this particular name for years. I tracked the over collateralization cushions. I track the premiums or discounts to NAV. And there was a period in the last 2 months where, because the equity puked back in the beginning of because the equity markets puked back in the beginning of November, these closed-ended funds went from trading at, like, call it 15 to 20% premiums to NAV, to all of a sudden 7% discounts to NAV. And I couldn't for the life of me figure out why. So I started buying. And then as I did more work, I realized that, I think this is just a retail, because closed-ended funds tend to be in retail hands, and retail tends to be less informed. I just got very aggressive, and I built a pretty large position. I bought at 7% discount to NAV at a 25% yield at the time. It's now, it's traded back to like a 20% yield, right? Which is still really, really good. But remember, the underlying collateral of a CLO is senior secured loans. They're at the top of the capital stack. When you look at the rest, when you look at in aggregate from a macro standpoint, what the rest of the capital structure of corporate America looks like, it's still super, super healthy. I mean, first of all, the bottommost rung of the capital stack is the equity market. You look at where the various equity aggregates are. I mean, I think they're trading at stupid prices. So I want to be short that segment. But if you go further up the capital stack and you look at things, aggregates like HYG, right, which represents the high yield market, you look at LQD, all these other aggregates, they also have ripped, right? So to me, CLO equity, even though it represents the lowest part of the capital stack of the senior most part of corporate America, I like that trade. And not only that, Rosanna, it's floating rate risk. It's floating rate. So if you think about what a leveraged loan looks like, it might be like a SOFR plus 500 loan, right? And so SOFR at 0 plus 500, meant that, just a year and a half ago, these leveraged loans were yielding 5%. Now these leveraged loans are yielding like 10% or so, right? And so you would think that, given that, there would be a dramatic pickup in defaults. But the leveraged loan market, because it is the top of the capital stack, so many things have to go wrong before a company lets its leveraged loans default, because they're at the top of the capital stack. I mean, you need to see the equity markets dump. You need to see the high yield markets dump and close, and you're seeing the opposite. So for me, this is my chicken way of riding this fiscal tailwind while funding puts on the lower parts of the capital stack. You follow what I'm saying? That's why I call it a macro capital structure ARB. I really, really like this trade right now. It's trading at a very slight premium to NAV, but it's only like a low single digit premium. And historically, because of the yields of these things, they've traded as high as 20 to 40% premiums to NAV. And right now, I think I own these things at 7% discount, but on a mark to market basis, they're trading at maybe like 4% premium. So, but I'm clipping like a 20% current monthly carry from these things. And that's money in my pocket every month. I don't need the greater fool to put that money in my pocket. I don't need to be a George Soros or a Stan Druckenmiller and be perfect in my market timing, right? That's what I mean by, I'm trying to on the one hand express this macro capital structure view, and at the same time be less reliant on the greater fool to make me right. because I know that that's a hard game.
Love it. I love it. I love these strategies. I love how everything's interrelated. You look at your whole portfolio and how you're using the money from this to help with the other part. It's like everything's all working together. It's actually very beautiful. So the greater fool, love that thinking. That's a great point that you make. Now, the CLO, what's your exit strategy with that? As it keep, what are you doing with that in
yeah, it's a great, okay, so it's a great question. I love how you hold my feet to the fire. So look, this particular name, and I apologize, I for idiosyncratic stuff, I'm very cautionary. I never talk about specific tickers, but
I know that. Yeah, that's why
there's only a handful of these closed-ended funds, and you can look them up, and there aren't that many to choose from. So during COVID, this was actually one of my biggest winners, because this same name that I currently own, I bought at a huge discount during the COVID puke, and I did deep work on it. Talked to the management team, tracked during COVID. This thing did get very. So I want to talk a little bit about that over collateralization cushion and what that means. The junior OC cushion in CLO parlance just is a test. It's a quarterly test that basically says, okay, you have to have enough cushion where you've satisfied all tranches of like triple B, single B and above. You've satisfied all of those tranches before the equity can get paid its cash flows, right? And so you have to worry when that over collateralization cushion goes down, because that's when the dividends could get turned off to the equity tranche, right? And so COVID was the only period where it got a little bit perilously close to that. But then with all the influx of all the different facilities and et cetera, I said, you know what, they're going to be able to rebuild their cushion pretty quickly. And so interestingly, I bought this particular security, call it at 7, and over the course of the next year and a half, wrote it up to 14. But during that entire period, right, I'm clipping double-digit yields. And by the time I sold it at 14, believe it or not, the yields had stayed about the same as when they were at 7, because they kept increasing their distributions, right? Now, why did I sell it at 14? Because it took great discipline for me to sell it at 14, because the yield was still very attractive. But at that point, I said, it's trading now at a pretty big double-digit premium to NAV, and I'm out, right? So that was at this point, even though I had clipped all these coupons or all these dividends throughout this period, the greater fool was willing to pay a much higher price than I was willing to hold. So I got out and I cut off my carry stream. But I always tracked it. I have this spreadsheet that goes all the way back to almost a decade now, tracking all these metrics on this particular name. And so when I saw that it puked to like a very, very rarely trade discount to NAV, but when it did briefly, I think in the last month or so, I pounced on it hard. So that's the Pelican swooping.
I love that. You're the Pelican. And I want to get into the Pelican because I know the Pelican was very active today with the OPEC plus. And so you make that's a great point. I think the Pelican is the overall theme. And what that means is you avoid fear of missing out and you spend most of your time chilling. And when you see, but you pounce.
I'd like to think that, but I feel like I've been like a little bit, yeah. I should be chilling. I should be chilling more.
I know. I was going to say that. I was like, you seem to be very active. You're more active than the Pelican, even though you talk about this Pelican. Now, the Pelican sees opportunities when he or she sees them. So tell us about your Pelican mode that you're in and how it works with the macro cap arb positioning.
All right. So I guess I'll divulge something I've never publicly divulged. So
Ooh, we're so excited.
a year and a half ago, I go on this unbelievable psilocybin retreat in Jamaica, right? And it's pretty transcendent, because on the third and final dose day, I did something like a massive 10 grams of psilocybin, where you experience complete dissolution of your ego. And I just experienced this unbelievable sense of peace, right? That I'd never experienced before. And then as I came out of it, I'm on the beach in this very idyllic place. And, I basically just spent like a couple hours hanging out on the beach and just like watching the waves and watching the pelicans. There were a whole bunch of pelicans just kind of hanging out on these like posts. And I'm just watching them, and they're just like totally chill, but they're chill but observant, totally observant. And I just watched them, like they would not expend an ounce of energy until they saw what was basically a sure thing. And then they get up, and then if the opportunity went away, they aborted very quickly and went back to chilling on the waves and conserving energy. So I had this big epiphany. I'm like, holy shit, I found my totem animal. It's that pelican. And I wrote this little thread. I said, you know what, investing the Pelican way. Like, I think I need to be a better pelican. And I think, Charlie Munger, rest in peace. I think he's always said that, like, one of the hardest things to do in investing is just being patient and just waiting. And that's exactly right. So I think I need to always remind myself of this and do a better job of being that pelican and not over trading and not getting sucked into FOMO and stuff. The FOMO stuff I'm much better at now. I feel like because I have no problems bucking the trend, and I have no problems sitting out this QQQ in the Mag 7 rally, because I just think that they're mispriced in this worldview that I have. But that said, I'm not going to be stupid about it and be boneheaded about it. So I'm finding ways where I can have my cake and eat it too, right? So that's why, like, I'm structuring my hedges in a way that's asymmetric, where if I lose, I never get hurt that badly, but better that I'm getting a lot of current cash flow that funds these bets. And in an ideal scenario, I can have a cake and eat it too scenario, where the equity markets tank, I make money on my hedges, and my position in sort of essentially senior secured loans doesn't negatively get impacted. But I know that nothing is ever perfect, and so yeah, it's just balancing risk versus reward, and
love it. It
always
always
easier said than done.
Absolutely. Yep. It's always about balancing that risk and reward. There's an entire sea of fish waiting, right? And there's no reason, there's always going to be a fish that got away. So the pelican should not chase it and waste any energy.
That's right.
Why you have so much wisdom, and it has to do with your systems thinking approach, which I try to utilize as well. It's a holistic, interdisciplinary view, and we apply Greek mythology, metal, everything, and to the markets and physics as well, partial derivatives, mental models. And I know we're going to talk about mental models with Charlie Munger. You mentioned great points. Yeah, great points. The Mag 7 rally, no reason to FOMO into that. If it doesn't make sense to you, you got to follow your style, and you've certainly found your investments that work for you. It's better to be generally accurate than to be precisely wrong, right?
I love that. I say that frequently. That's another Charlie Mungerism, I think. And really? That's my version of a Charlie Mungerism. Yeah.
Market wisdom. I love it. It's just wisdom. And then I want to, before we go into the next part, it's very important that we talk about something, the Bitcoin, gold, crypto, all that. You've tweeted that the reason why you call these the greater fool trades is that they're 100% reliant on the greater fool for an exit strategy like you just spoke about. Now, we both agree higher for longer, inflation is embedded, all that, stagflation is possible, and we could be in for a hard landing. So everyone seems to be hiding in gold, Bitcoin for those type of hedges. You don't see it that way. Tell us more about that.
I mean, look, more power to the people that have made money in these trades. The problem. Okay, so I'll just talk about gold for a second, right? It's not that I'm bearish gold. I'm more indifferent to it because to me, when you have an unfalsifiable thesis, how do you determine entry and exit? So to me, is gold an inflation hedge, or is it a deflation hedge, or is it a geopolitical hedge? Is it all of the above? Is it none of the above? I call it a chameleon trade, and Bitcoin is like a hyper version of that to me. And so when I can't identify the underlying thesis or entry and exit conditions, I feel like I have zero edge in that. And you know what? If you've made money speculating in it, that's great. I just choose not to. It's not my thing. I can't ever have really conviction in it because of that reason. So I just choose not to, and I don't have the FOMO of not being in them when they work, because there are other ways. There are many ways to skin a cat. There are many ways to make money. Another big lesson I've learned throughout my career is that you also don't have to make money back in the same way you lost it.
Yes.
And that is, I cannot tell you how important that is. And it took me actually a very, very long time to truly understand that, because it just requires a little bit of maturity and maybe some age to realize that there will always be opportunities. There will always be fish in the sea. And if that fish gets away, you don't have to keep expending energy chasing that one fish, because there's so many more.
I love that. The market is an ocean, and there's plenty of
That's right.
opportunities. There's plenty of fish out there.
And it's just having the maturity to realize that, because for a long time, I have to admit that, like in my early years in managing my fund, I sometimes became very stubborn, and I would fight a losing position for a long period of time, and eventually many of them did turn around. But when I look back upon some of those, I think of them as mistakes, because there was opportunity cost. There was so much energy expended in fighting some bad trades that even in the ones that eventually worked out, I probably could have made so much more had I freed my mind and capital up earlier. Right. So that to me is look, better late than never. I think I've learned that lesson. I always have to remind myself of that lesson still sometimes. But I think that's really critical.
Absolutely. We're always learning, and you have to know yourself is so important. And know what works. Know thyself, right? And so those are some wise words there. And there's quite a few wisdom that you tweet out. There's another one that I really liked that says there's nothing worse than taking equity downside risk for a fixed income expected return.
Oh yeah. I love.
Tell us about that.
You picked out some really important ones. I think
they resonate with me. They really resonate.
I think that's a critical point, because you remember there was this whole thing about venture debt, and I remember I tweeted something out. I'm like, why does venture debt even exist, really, right? Why would you, I guess in my mind, right, if you're lending money to a pre-revenue or a very low revenue company, you are taking equity, you are taking equity downside for a fixed income return. And that is horrible, 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 horrible. Because, you know, here's the other thing that where this dovetails nicely, right? If you think about the capital structure as a continuum of bundles of cash flows, which is how I've always thought about the capital structure. At the bottommost layer, the equity layer, you basically have the most subordinate layer. But let's start it the other way. At the top of the capital structure, you have senior secured loans. The coupons, right, are contractually defined, right? We talked about those represent event-driven strategies because they're defined by contract. They're going to get these monthly or quarterly payments. The principal payments are contractually defined, right? As you go down the capital stack and you go to high yield bonds, senior secured, senior unsecured, and you go down to convertibles, the contractual protections that you have become more and more relaxed. Okay. Therefore, the associated yields should be higher, right? Until you go to the very bottom of the capital stack, where you no longer have any contractual protections, because the whether a stock pays you a dividend or not depends on what the company wants to do. Many stocks pay no dividends, but you're supposed to value them as if that these cash flows that are coming to the company will eventually manifest into either explicit dividends or some sort of terminal value that's out into the future, right? But when you think about what stocks and bonds have in common, they're all bundles of cash flows. It's just that in the bond world and the loan world, the principal is that terminal value, but that's contractually defined. The interim coupon payments are contractually defined returns of capital, if you will, or interest on capital. But with an equity, you might not have any of those contractual payments. And so when I talk about duration risk, I think of it in a very, very broad sense, because to me, what's exceptionally scary about the narrowness of this rally and how all this value is concentrated in like the Mag 7 and sort of high growth stuff is that those equities represent almost all of those equities don't pay current dividends. The terminal values are pricing in very, very high growth rates and very, very high terminal multiples, which, at least in my worldview of higher for longer, just don't make sense. I think these equities need to re-rate significantly lower in terms of equity multiples, right? So now I'm kind of forgetting what your original question was, but
this is great. No, this is awesome.
Oh yeah. So that's the continuum. The way I think about the continuum of capital structure. But wait, what were you asking me where I went down that tangent?
I forgot.
I lost you too. Wait. No. You were asking me about a saying that I had about taking. Credit risk. Yes.
Equity downside risk. Yes.
Right. Okay, right. So that's why I went down that rabbit hole, because so now that I've talked about the continuum of the capital structure, as an investor, as a value-based investor, I've always tried, like when I was looking at bonds, I would like to buy bonds ideally that have equity characteristics. So you can buy bonds that have equity upside characteristics, right? And you can also wind up in equities with sort of more bond-like characteristics.
Yes.
Because if you let's think of it this way, right? If you buy bonds in deep distress, you are buying essentially a call option on the firm's assets again. Just like equities are call options on a firm's assets. When you buy a bond near par, you're actually assuming a short put position on the company's assets. So now we're opening up a whole different can of worms, but
yes.
now this is thinking about the capital structure.
Yes.
Right? You talk about a different mental model. Now you're thinking about, I'm talking about the Merton model of thinking about the capital structure from a real option standpoint. So now, right, I just explained how the capital structure can be thought of as bundles of cash flows. Now I want you to just take that hat off and put on a different hat, put on your options hat, and think about the accounting identity where assets minus liabilities equal equity.
Yes.
Okay. That accounting identity suggests that the equity is very, very similar to a call option on the firm's assets with a strike price of L. A minus L equals equity, right? So the equity is a call option on A, but with a strike price of L. So in other words, if you have a firm that has assets worth of 10, and it's got liabilities worth of 5, the intrinsic value of the equity option is 5 because 10 minus 5 is 5. Okay. Now, what if, and then let's think about if you own a bond, the bond is the L, right? If you own a bond, you're actually short a put on the company's assets. Because if you think about it, right? If you think about it, the put premium that you're getting from shorting that put is basically all your coupon income, all your spread income. Okay. That's basically like your put premium that you've sold on the company's assets. Now, if the company's assets are worth 5, you're going to get par at the end of your maturity. You're going to get 5. If the company's assets are worth 10, are you going to get anything more than 5? No, because you've sold a put. The residual goes to the equity, right? All the upside goes to the equity.
Yeah.
So the equity has the call option. Okay. If you're long the bond, you're short the put option. So here's the short put, here's the long call, right? Right?
Yeah.
So but here's what happens, okay? So if you think about being long the equity, being long optionality, that's inherently kind of a long gamma type of structure, an asymmetric positive gamma, positive convexity structure. If you're long a bond, that's inherently a short gamma, short convexity type of trade, right? Because you have asymmetric upside. So to bring some meat to the bone of what I said about taking equity, having equity downside for fixed income risk, it's this. Because if you've got this short put position, right, you are taking equity like downside here. What if the firm's assets were only worth 2? Well, you just sold a put at 5, right? And the assets are worth 2. And if the company liquidates, you have now lost 3. Okay. The equity is going to be a 0, but you knew that going in because you have all the unbridled upside if the assets are worth 10, right? But you as the bondholder thought that you were going to get 5 and you only got 2 because the asset, there was major impairment of the assets. But okay, here's the thing. And I used to have these intellectual debates with my former boss, Mitch Julis at Canyon, all the time. What's so fascinating is that when you buy bonds in distress down here, suppose you were able to buy a bond at 2. That's a long gamma strategy again. That's like buying an equity again. It's the optionality is yours again. My biggest, my career winningest year came out of the great financial crisis because I was buying severely distressed convertible bonds that had traded down to something like 4 to 5 cents on the dollar. Those are no longer short puts. Those are very much long call positions again. You see what I mean?
Yeah. Are those the Fulcrum securities?
Yeah. Well, so the Fulcrum security is a different concept. The Fulcrum security is that part of the capital structure that moves with the most asymmetry given even a small change in the overall enterprise value. Okay, so for instance, if you have again, you go to that accounting identity, right? Let's say that assets are worth 10 and the company has no debt, so L is 0, right? Well, then it's very clear that any change in the firm's value, any change in the A falls 100% to the equity, right? So if A goes to 11, the E goes from 10 to 11, right? Because, right, so clearly the E is the fulcrum because any change in the, right? Okay. But what if, okay, let's go to extremes. What if, let me think about how to express this. Okay. What if the liabilities were, let's think of a more complicated capital structure now. Let's think about how you've got firm assets of 10. You've got liabilities of 5.
Okay.
Let me think about how to express this. Okay, so if a company is very levered,
yes,
okay, you could have a situation where the fulcrum security is no longer the equity, because let's say that the firm's assets have now dropped to 6, but you've got liabilities of 5, right? Technically speaking, there's still enough asset value there to cover the bonds of 5 fully. So your fulcrum security is still very much the equity. You follow? The fulcrum security is still the equity, right?
Yes.
But let's say that there's uncertainty now with respect to the assets, and the assets could be only 3. Okay, but your par value of bonds is 5. But now let's say that the bonds are now trading at, I don't know, 50 cents on the dollar, right? Okay, so if the par value of bonds is trading at, if the par value is 5 at 50 cents on the dollar is 2.5, right? But the assets are worth 3 or maybe more. The fulcrum, you see, the fulcrum now is actually the bonds, because if you can buy the bonds at 2.5, right? As long as if the asset value goes from 3 to 5, all of the value accrual goes to you, the bonds, before the equity sees a lick of value.
Yes.
You see what I'm saying?
Yes.
So that's an example where the fulcrum security is now higher up in the capital stack.
Yes.
right? So like the biggest, my career winning this trade was basically riding a single capital structure and jumping from fulcrum to fulcrum.
Wow.
So for instance, in 2008, General Growth Properties was a very, very levered REIT, right? That went bankrupt.
Mm-hmm.
And I don't know if it's been so long now, but I don't know if these exact numbers are accurate, but it'll be in the ballpark. This company had something like 25 billion of senior secured debt and only 1.5 billion of senior unsecured convertible debt. And then, it used to be like a multi-billion-dollar market cap company, but during 2008, the equity goes to zero essentially, or it essentially went bankrupt, right? But get this, that 1.5 billion sliver of convertible bonds traded down to 4 cents on the dollar. Because there was so much senior secured debt ahead of it, right? And so I remember at the time, Bill Ackman was making a big play on buying the equity at 20 cents a share or something like that. And we were like, we have a much better trade. We were buying the senior unsecured convertible bonds at 4 cents on the dollar. That was the fulcrum, not the equity. So what happened was in 2010, 2009, maybe, we bought these bonds at like 4 cents on the dollar, whatever. And then when I don't know, I think things didn't start moving until maybe the summer of 2009.
Mm-hmm.
These convertible bonds went up to like 70 cents on the dollar, right? So yeah, we killed it on that trade. But at that point, I changed the trade. I basically said, look, the fulcrum might be jumping to the equity here. Because at that point, the equity, Bill Ackman had done well too, but I think he took a lot more risk because he bought the equity at 20 cents. The equity was maybe, I don't know, $3 a share or something like that, right? So he did really, really well, right? But but we also did really, really well going from 4 cents to 70 cents, right?
Mm-hmm.
But at that point, I changed the bet completely. I said, what if? Because I at that point, I still don't know whether or not all these like Fed tools are going to help turn the economy around, right? And I don't know whether this is real or not. So I said, I'm going to sell all my bonds at 70, and I'm actually going to go short these bonds because I know that all I can lose on my bonds is 30 points because they're only going to go to par, right? Remember, I'm short. The bonds represent a short put. So if I short the bonds, I actually have a long put.
Yes, exactly.
Okay? Right? So I short the bonds, but I thought that the fulcrum might be jumping to the equity because if this is a real economic recovery, the equity, if it's the fulcrum, the equity could wind up being like a 4-bagger or a 5-bagger, and I can only lose 30 cents on my bond short. So my new capital structure play was I was short the bonds that I was long. I was short at 70 cents, but I went dollar for dollar long the equity. So you fast forward a couple of months, stock is at 16. So we 4.5 times our equity, and we lost our 30. We lost our 30 cents on the bond. So that was like home run number 2.
Wow.
Then what happened was that the reason why the stock ran to 16 was that there was a bidding war between Simon Property Group and Brookfield for GGP. So the stock just ripped, and it was a whole totally different world at this point. This is probably in early 2010 or something like that, right? Totally different world. Right? GFC is a distant memory, right? So at some the merger, I think the proposed merger falls through at some point. We monetize really well, and the stock now falls back to, I don't know, like $10-12 or something like that. And so now I had a completely different trade again. Now I think that, to me, the equity is now solidly the fulcrum. It's a cheap value equity, with no longer with the bankruptcy risk that it used to have. So I went long the equity again at 12 after selling it probably around like 16 or something like that, thinking that, okay, I now have like maybe $2 of downside in the equity. But on the other side of my book, the way I hedged it was I had a basket of convert arb trades in the REIT space to create essentially synthetic puts on the sector, if that follows.
Yes.
And so that was a 2010 formulation around this GGP, and we wound up making money there too, because the GGP equity, it wasn't so much that we made a bunch more money on the GGP equity as it was that the convertible arbitrage plays wound up making a lot of money. And that was an ironic trade where my hedges wound up making more money than the actual thing that I was hedging.
Love that.
Yeah, so that's how I ran my fund, and that's how, obviously, like when I, as a private investor, and I gave up my prime brokerage, and the markets are different. I don't have as many tools at my disposal as I did when I was actively running my fund, but I still think like that. I still think of the world in those types of terms.
It's all about mental models. So it's important that you continue thinking like that and looking for those seriously distressed value strategies like that. Now, I just want to briefly, for the audience, when you talk about the going shorting, you meant long puts, basically buying the puts. And since the bond is a short put, it ends up being like a spread. But yes, those are great points.
When you short a bond, when you're long a bond, you're inherently a short a put on the firm's assets.
And that's bullish.
So by shorting bonds, you're effectively having you're creating a long put position on the company, essentially, on the company's assets. And this time, the put premium you're paying out is the negative carry you're paying out by shorting the bond.
Love that. So creative. So I was going to ask you, now you bought these 4 to 5 cents, and then you were able to turn around and sell them for 70 cents. They went up to that. That's amazing. Amazing investing. Home run for sure there. Now, that was 2008, coming out of that GFC. Now, fast forward to today, a lot of headwinds going on, potentially replaying 1970s and high debt. Are you starting to get your feelers out there and looking for opportunities? Because you and I both know challenges bring opportunities. You just have to look for them, and you have to think out of the box, be creative. Are you thinking that there may be some?
So that's the thing, right? So I fully recognize that, like, being in the CLO equity, right? That's another. I still am writing puts there, right? But what gives me relative comfort is that I'm using part of that positive carry to fund puts on much lower parts of the capital structure, right? So to me, from a macro standpoint, for me to really get hurt, for the leveraged loan market in general to really get hurt, I think bad things have to happen to the equity markets and high yield markets, and I'm not seeing that, but I'm hedged for it, right?
Yes,
I'm exactly hedged for it. So that's how I'm looking at the world. I mean, it's very interesting. Like during, coming out of COVID, I tried to invest. Do you remember there was this strategy? There was a facility that they rolled out. They rolled out so many acronyms during COVID, but there was one called TARP. It stood for something like Troubled Asset Something Fund. Asset. I can't remember what the L stood for, but it was very interesting. And it was basically a facility, because there was so much credit dislocation at the time. It was a facility designed to go buy essentially AAA corporate debt, right, and essentially lever it up and deliver to the end investor a sort of 12 to 15% IRR. And to me, I'm like, let me at it. I mean, you know, I'm essentially taking AAA risk. So therefore, I don't mind levering it up 5 or 10 times to get like a very stable 15% IRR. So, you know, I sent in the subscription docs and all that stuff. And by the time they did the money raise, everything had been priced out and they wound up returning all the capital. Like nothing ever got deployed. It was super frustrating. But in a way, CLO equity reminds me of that. I mean, obviously, I'm not buying, the underlying isn't AAA corporate. It's leveraged loans. It's sub-investment grade credit risk. But the thing is, though, these are still senior parts of the capital stack. And there was a podcast I listened to a couple of weeks ago, which I thought made a real, I think it was an Odd Lots podcast with a BDC manager, another type of credit instrument. And they were saying that the interesting thing about the private credit markets right now is that a lot of the private lenders just happen to be the credit departments of private equity groups, right? That have a lot of equity skin in the game. So they need and have very, very high incentives to support their underlying equity position. So like for them, if for instance, if you're the private equity owner of Asurion, let's say, right? And let's say that you've got like $1 billion of private equity at risk, right? If it means that you're going to, and let's say that Asurion runs into financial difficulties and requires a refunding of their senior secured loan, well, you as that private equity owner of Asurion have $1 billion of equity to protect. So are you going to help them roll a $200 million senior secured facility? Of course you are, because you've got a lot more skin in the game beneath at the lower ends of the capital stack, right? So that's how I'm thinking about it, right? Because the capital structure matters. And so for the senior secured rung to really run into difficulties on a macro basis, a lot of bad things have to happen to the lower rungs of the capital stack. Again, on a macro basis. I used to do a lot of this stuff on a micro basis. This is my macro equivalent.
Love it. Exciting. You made some excellent points there. It's important everyone knows that there are equities that are more bond-like and there are bonds that are more equity-like. It's sort of like a continuum. And I think you actually used that word in a tweet. Very important to know that. And that, you know, stocks and bonds are artificial terms for bundles of cash flows. And they all have different duration characteristics. So I want to get into how your long, short duration, low duration, you can use either word there, versus the your long short duration versus the high duration. If you tell us that thinking and that mental model regarding duration.
Well, okay, so when you go back to the cash flow, the bundles of cash flows, right? It's you know, when you have let's say that you have a bond that has zero coupon. It's a zero coupon bond, but let's say it's like a 30-year duration, 30-year maturity, right? Then you've got this one balloon payment at the end.
Yes.
So that's what you call a very high duration,
very sensitive
high duration bond, right? It's extremely sensitive. I wrote a mental model thread maybe 2 years ago about thinking about these in terms of levers, right?
Financial assets as levers. I love that.
As levers, right? And so that's exactly what it is, because it's like having a security that's where even a small push on the interest rate side of things can move the underlying asset value by a lot, right? A short duration asset is very different, right? A short duration asset is where let's say that you've now got coupons, but it's an amortizing loan. So the principal payment is being amortized throughout. You don't have this big balloon payment at the end, right? That's a much shorter duration instrument because the principal is getting paid down at the same time as interest, right? And so if there are movements in interest rates, that gets affected far less. And you can say the same thing for equity. Like, my Permian Co. Oil and gas private equity is a self-liquidating private equity, meaning that as we produce oil and gas and we sell it, right, those cash flows get distributed out without being reinvested into the ground. So unlike a public market E&P, where the terminal value is going to be very, very sensitive, in this case, not necessarily to interest rates, but to oil prices and the strip, okay? In my situation, it's a naturally duration shortening bet, because with every cash flow that I receive, the duration of the asset, the terminal value of the asset, is getting worn down until eventually, maybe 10 years from now, it'll be down to like a very, very small amount. So it's, again, I'm not as reliant on the greater fool.
Yes.
Right. So even if oil prices crashed in the short term, right, I don't think, because I do have a longer term constructive view on oil, I don't think they'll necessarily stay down for a long period of time. And so the reason why I think I can potentially have a cake and eat it too moment with my hedges is that, if we go into a very hard landing scenario in 2024, I could see oil crashing, right? And I could see that easily happening. But because my private equity play is duration shortening, and we're hedged too, it's not like we just balls out, don't hedge. I talk to the management team all the time, and they hedge. It shortens the duration that way too. So that's how I think about duration. It's you have to think about capital structure as a continuum, because and to me, my equity plays, I want them to be either short duration plays and or event driven, where the underlying exit strategy is predetermined. And for the things that I want to short, I want to focus on the long duration sensitivities, where if we do have like a hard landing type of scenario, especially if it's due to a higher for longer type scenario, then I think ultimately the things that get re-rated down the hardest are things that are 100% dependent on terminal values, right? And so to me, like, stuff like QQQ, high multiple growth stuff is at risk. And I think they're pricing in unrealistic growth assumptions. It is what it is. I mean, my puts aren't obviously making me any money right now, but I'm more than making up for it by just from the carry component of my book.
Well said. Love that. So. Okay. So I want to mention one of your other wisdom, your other tweet. You said, lack of conviction is like negative gamma. It makes you buy highs and sell lows. Big reason why it's much better to not trade than to trade with low conviction and or other people's ideas. And this goes right into what you just said.
Yep.
about the macro and what you feel is going on, and not to give in to that greater fool trade.
Well, gamma, negative gamma, just to explain to the audience, if people in the audience don't understand options. I mean, look, gamma is the concept of gamma is when you have when you're long optionality and you're long gamma, you're in this enviable state where you get longer as the market goes higher, and you get naturally less long as the market goes down. So it means that you have a self-contained safety valve. So if you're long an option and the underlying stock goes up, you're always in a position where you can be a seller at higher prices. And because when the stock goes down, you're getting less long, you're always in a position where you can, if you hedged out your option, you're always in a position where you can cover shorts as things go down. So long gamma puts you in a natural state of buying low and selling high. If you flip that on its head and you're short gamma and you're short optionality, it's the exact opposite. This is why, when people say that, there's a gamma squeeze on the upside or downside, these gamma squeezes happen when people that are short gamma are forced to chase highs, right? If you're short gamma, you naturally get shorter as the market goes higher, and you get longer as the market goes down. Think about how bad that is. That puts you always on your back foot, because if the market goes up, you're forced to cover shorts at highs, and the market goes down, you're forced to puke out at the lows. And it's the worst possible thing. One of my original boss at Goldman, this unbelievable trader named Jimmy, who ran the precious metal, basically the GSCI precious and base metals desk. He called it whip. He called gamma whip, negative whip, positive whip. It's like, beware that negative whip, because, and I've seen, one of my best friends from that period, I learned at his expense, because he was short. I'll always remember this trade where he was short these aluminum straddles. And he thought that, he was making a fortune by pocketing all this premium, right? And got carried out on this trade. Absolutely got carried out, because it was massively negative gamma. And so in general, I'm very, very wary of being in a negative gamma situation. And so when I wrote that tweet and I talk about having no conviction, it's just like that. Because when I'm in trades where I have little conviction, the slightest adverse move makes me want to puke it out.
Yes.
And then when it bounces back and I have experienced FOMO, I want to buy it back. And that's so damaging. That's just so damaging that in periods where if I do find myself reacting that way, is when I have to really discipline myself and say, you know what? I got to be a pelican. I got to go back on the waves and just chill and stop lacerating myself with these stupid trades, right? Because it happens to the best of us. It happens to everybody.
To all of us. Happened to me before.
It happens to everybody.
Yeah.
Yeah. It happens to everybody. And so it's basically like, greed and fear, right? Like one of my favorite investment books of all time that I've probably read at least 20 times is Reminiscences of a Stock Operator. I used to make all my analysts and read this book, because the markets can change, technology of the markets change over time, but what never ever changes is human emotions of greed and fear, right? So it's greed and fear, and the fear could be fear of loss, could be fear of missing out, but it's fear. And greed speaks for itself. So that's basically you have to build in. And my whole focus on predetermined exit strategies is to try to immunize as best I can, immunize myself from my emotional self, right? Because I know myself. I know what my strengths and weaknesses are. At least I think I do. And I'm trying to save me from myself by having predetermined exits so that I don't get whipped out like that.
Well said. The cycles of the market are run by humans, human emotion. And so we need to, it's not about controlling our emotions, it's about not reacting and not acting impulsively based on those emotions. And so once you're in a trade, it's like your emotions take over and you get a lot of that greed and fear working back to back. So wise words there. It happens to all of us. So I think you tweeted this, having well-researched thesis with a well-defined exit strategy and getting the F out of the way. You actually said, I love that. Patience to let things unfold is the hardest thing to do. Michael,
is that my investing thread that you're reading all this stuff from? I forgot where that's coming from.
I have to tell you, I went through your Twitter because you have so much wisdom. And I
went
through
deep.
Yeah,
and I don't even know where you're getting that.
I went through your Twitter and I went through your amazing Substack, which I love. And so you have so much wisdom. I think you could write several trading books that would be like trading Bibles for people because you have so much wisdom. And there's another one here. I have another one here for you. I want to ask you this question. Why does the market have an uncanny way of pricing things right to your indifference point?
Yeah. Yeah. These are all Mike-isms. I used to say this. These are a lot of these sayings that I put into that investing thread are things that I used to say to my analyst team all the time. And that's always that's always, it seems like that happens a lot, is that, the market can be pretty efficient sometimes, and it just prices things right to your indifference point where it's too cheap to sell, but not compelling enough to buy. And then you're just sort of, you're stuck.
Yeah. You're in that holding period.
And yeah. And so to break that logjam, sometimes I would just force my analysts to say, you know what, there's no hold. You have a gun to your head. You have to either buy or sell, make a decision. So because sometimes what I find is that analysis paralysis sets in.
Exactly.
And the problem with that sometimes is that these, it's like the boiling frog analogy, right? Where this paralysis sets in, and before you know it, a small loss becomes a big one because it happens over time, and you just keep stewing in that boiling pot until you've been cooked. So
exactly.
Yeah.
So this has been absolutely amazing. I know we've been doing this for a long time. We've been talking. We could talk for days about the U.S. dollar wrecking ball. Your wrecking ball dollar hegemony. I mean, there's just so much to talk. You have so much. I'm going to tell everyone they have to come to your Substack. Amazing. We're going to put it in the description. You have an amazing podcast too, Chaos Theory, and so they have to follow you on Twitter. Brilliance. I mean, I support you, and I love all your tweets. Just very well thought out.
You're too kind.
And I mean it. You're really awesome. But I want to know, based on your extensive experience in macro and markets, geopolitics, what is your feeling on what could break the camel's back? You and I both feel that could be a hard landing coming up. Is it the real estate market? Is it, and what do you think? Sovereign debt, sovereign bonds, big one there, debt crisis we have, all this mass spending. What do you think? We could have that black swan or something.
Yeah, so that's the thing. I mean, this is, I have to admit that I've been, it's becoming more and more evident that this fiscal tailwind is much stronger than what anybody thought, and nothing has broken. Nothing has broken. So like when people are thinking that, oh yeah, the Fed's going to cut 100 basis points, I don't see the catalyst for it. I just don't see it. I mean, so unless we see a dramatic spate of job losses, I don't think the Fed is at that point where they need to be in a hurry to cut anything, because I really think that at least Jay Powell's mandate is to make sure he's not remembered as an Arthur Burns, where if he cuts prematurely, he reignites inflation, and then he subjects the market to a second round of tightening. That would be a disaster, right? So I think that I tweeted out the other day. I said, in this vodka Red Bull economy that we have, if you inadvertently keep adding in Red Bull, you wind up diluting it with more vodka. But it's not a dilution, right? Because you're going to wind up completely wrecked in the end.
Exactly.
So I think the vodka Red Bull mental model is actually a pretty good mental model.
Excellent. It actually is, because it's not, one's not going to offset the other.
You're going to get wrecked.
Yeah.
You're going to get totally wrecked at some point, because the Fed, if this fiscal continues and keeps inflation sticky, and the Fed just stays high for a long period of time and or starts hiking again, something will break. I think and going back to the dollar thesis is that I do think that because a lot of the other countries of the world don't have this same fiscal tailwind that we have, and also some of the other resiliencies that we have, like the floating rate resiliency, the energy independence resiliency, I think it's pretty highly likely that other countries' economies will break first and force their central banks to start easing first. So, and I'm expressing that through various, currency crosses. I'm short the Chinese yuan, I'm short the Hong Kong dollar, I'm short the euro. So all based on that thought.
Well said. I know you have your 4 horsemen, and I'll just name 4 of them: the demographic tailwinds, the fiscal dominatrix, the less floating rate dependence, and energy independence. Excellent points there. I agree with you. The fiscal tailwind that we're in. And, my concern is the wall of maturities that's coming up. We're going to be refinancing at much, much higher rates if the Fed maintains at this higher level. This level we're at right now is.
Are you talking about corporate? Are you talking about corporate or household maturities?
Well, first, all of the above. First of all, the small businesses, there's so many bankruptcies are up. Small businesses are most sensitive to these higher rates. They're refinancing at much higher rates, right? Households as well. We have increasing debt. You see all the research out there, how high the debt is for the public debt. And people aren't realizing that the rates aren't coming back to where they were. And so much higher cost of money. And then bigger corporations have until, I think it's 24, 25. So I think that's going to, unless we get some major, pivot cuts or something, I just don't see that right now. And the way there's so much resilience, like you say, about the US economy right now, you still have unemployment's trickling up. It's at 3.9. We're getting it across the board, 50 states increasing in unemployment. Job openings are down. We're getting layoffs, but still, we still don't have any real momentum to get this Fed to cut. I know the market is taunting them. The market's saying, hey, we're going to run. Mag 7 are running. We're having a strong end of year, but we'll see. So that's why I wanted to ask you, what's going to break? Because, a lot of economists are saying sovereign bonds will be the one. So we'll have to wait and see. But in the meantime, I guess you're being a pelican. However, you do have you have your carries funding your shorting of the market. Exciting stuff that you have. I
I mean, you
love
have to,
your.
this is why paying attention to like global commodities like oil and also what I
Mhm.
call like the non-cartel commodities, like the other industrial based metals,
Yeah.
is important because to me, the weakness in all of those is a global canary in the coal mine, right?
Yes.
It's a tell that the rest of the world, right, is suffering disproportionately to the US because it is a mistake. There a lot of oil and bulls tend to be very US or North America centric, but you're
Mhm.
forgetting the fact that in Asia, for instance, you've got a twin wrecking ball of high oil prices and high dollar, right? So no good will come of that. No good
No.
will come of that. And so you're seeing that happen. And so yeah, I see your point. The wall of maturities, and like when I think about like my CLO equity exposure, that's a concern. I know that like in my particular closed-end fund, their wall of maturities, their maturities are literally negligible until 2005, and they start picking up a little bit. But again, see, there's in the US at least, this this private credit phenomenon is not to be trifled with, because when you've got these private equity sponsors with so much more equity skin in the game, it's
Mhm.
not like the LBOs of the 80s, Rosanna. It's not
Mhm.
like where they had very little equity, but it was all leverage. Nowadays, private equity firms have a lot more. Let's think of it as a lot lower. The leveraged borrowers have much lower LTVs, right? Because
Yes. Yes.
the equity checks are so much bigger. So what that
Mhm.
means is that this charade can go on much longer
Yes.
because these companies are going to be kept afloat by their private equity sponsors that also happen to have a $30 billion credit fund to lend to those private equity holdings, right?
Well said. Exactly right. And they're lending at higher rates. These higher rates help these companies that are debtors, and they're lending out at higher rates. So I think it will go on much longer. I
And
think.
here's the thing. I know we're running short on time. We've been talking for a long time, but I'll just tell you that, like,
Please.
I've in micro cap land where I focus on some of my idiosyncratic stuff, right? I'm seeing this happen where you've got companies that have too much leverage, right? That because they have way too much leverage and they are forced to delever, they're selling critical assets that are to delever, but these assets are, you're not trimming fat anymore. You're cutting into the muscle and bone here,
Mm-hmm.
right? So after when companies are forced to do that, what's going to happen is the growth multiples are going to re-rate down.
Mm-hmm.
They have to.
They have to.
They have to. So the Mag 7. You could argue the counter argument is that the Mag 7 are in net cash positions,
Yes.
and so that's obviously the market has crowded into this tiny little island of companies. But even the Mag 7, despite their cash hoards, I think ultimately they're still subject to macro financial gravity, which is, I'm not sure it makes sense to pay 25 to 30 multiples,
Mm-hmm.
uh, where if the rest of the world is contracting in growth, are these Mag 7 really going to magically sustain their growth such that they can command 25 to 30 times multiples? I mean, that's why I call the Mag 7. It's kind of like Jon Snow's little cadre of guys that got stuck on that little ice floe, surrounded by like the Night King's Walking Dead. I mean, The problem is that Jay Powell is no Daenerys, and he's not coming to the rescue.
No. And, you know, you have to think you have to look at excellent analogies. I love that. I love the vodka Red Bull.
That's my Game of Thrones mental
I love
model.
it. Game of Thrones. I need a Star Wars one. You know, I think that you have to look under the hood and say, but who are the customers of these big companies? And how are those customers, right? How are they affected?
Exactly. There's no magic.
There's no one escaping.
That's what I mean. There's no magic bullet here. It's like, where are they getting the growth from?
Exactly. And so for now, they're riding on this, but eventually it'll all catch up. And so there you go. You're just, you know what they say, macro. I love Benjamin Graham says that, I have this quote actually on my website, says in the short term, the market is a voting machine. In the long term, the market is a weighing machine. So I think eventually the macro will prove itself. But for now, I think we're just in this like a holding period. It does what it does, right?
You just never know. It's very, very hard to pin the specific catalyst, but you know, that's why
we'll be watching.
I'm not gonna.
We'll be watching for opportunities. The Pelican will watch for those opportunities because there are plenty of them in this market, in this ocean of a market. Right? I think that's good. We end on the Pelican. I love the Pelican. Right.
The Pelican.
Yeah, that's going to be my bird too. I think I'm gonna have to focus on this. I love it. There he is.
That's my Pelican.
I love it. Okay, so tell our audience how they can follow your wisdom.
Oh, please, thank you. Just Urban Cowboy, KAO, on Twitter and on Substack, urbancowboy.com. And awesome. That's it.
Love it.
Thank you so much.
Thank you so much. So much fun. I can't wait to meet up again. Maybe we'll be at a Metallica concert.
Yeah, exactly.
Definitely. We'll do this again. Thanks so much, Michael.
Thank you, Ro.